Now that the stock market is declining, more and more opportunities are arising. In this video, we discuss 5 established companies with proven earning models and potentially undervalued stocks, not so much because they are cheap, but because of the relationship between relatively good valuation and future profit growth, often protected by some form of competitive advantage. My name is Jorik Vermeulen. I've been investing for over 10 years, starting at 23, became financially free, and I'm on my way to financial independence. What does that mean? That you can live off the returns, and with happy investors, we help people with simple investing for financial freedom. And the primary task, in the meantime, it's about not losing our money, and especially to generate money, returns, not because money is important, but because financial freedom allows us to lead a more enjoyable life. And I hope that you can reach that financial situation someday, also through our videos. Of course, why? So that you can enjoy financial freedom afterwards, work less, and you can find more energy in doing what you really enjoy. For example, developing your ikigai. This way, we can provide more added value and positivity to the world. And that is really necessary. The first stock with interesting growth prospects is Expedia Group with the ticker XP. Now, if we look at the historical valuation, it seems like the stock price is slightly above the fair value line. If we zoom in a bit on more recent results, we see that the price is below the fair value line. What does this mean? Expedia Travel Group has a potentially interesting return for long-term investors. Note that the current price to earnings ratio is relatively lower, and this could be due to the EPS growth expectations. These have been established by a lot of analysts, so we can assume that the average consensus might be correct, or at least in that direction. Can it achieve a return on average almost 20% per year? That's significantly better than the current option for example, the S&P 500. Let's assume a slightly lower multiple, for example. If it's below 15, we could achieve an average return of 50% per year. Keep in mind, with all these forecasts and projections, it never turns out to be 100% accurate. There are always possible unforeseen issues. It could also be better than expected. So take a good look at the company to see if it's fundamentally sound. And it never goes in a straight linear line. It always goes with ups and downs. But on average, the EPS estimates could be correct. Moreover, I myself have held a position in Despegar for quite some time. Unfortunately, it was taken over by Process at a 60% plus return. So it's a shame. That was a long-term investment for me. But what's relevant is that Expedia Group had a 50% stake in Despegar, so they will cash in on that share. The current valuation is pretty okay at the moment. So the price to earnings ratio for next year in this data model is 17.5. Here, we ask for 15.5. Slight difference. We see that the bad luck ratio is around 1. Ideally, we want it to be below 1, but this is a reasonable valuation plus long-term for growth. Expedia has made good progress. Lately, the price for cash flow is relatively low. The price for sales is a bit on the high side. The market value is 25 billion, so definitely not small. The total debt may seem high, but considering the cash position, it's all fine. At the moment, the factor analysis is a buy. Statistically speaking, a buy is not a strong buy, but statistically speaking, the factor analysis indicates that this is the stock. In any case, it has a better chance of success than average. That doesn't mean, of course, that it's true. Regarding growth prospects, we see that the EPS growth for the long term is estimated at around 11% for the next 3 to 5 years. That's a lower estimate than in the model we see here. So keep in mind the possibility of less growth, but still considering the acceptable valuations. And of course, you still need to do your own fundamental analysis here. It all seems promising. In the very short term, Zach Schenk gives a buy signal. They expect the price target to be around $12,212. Admittedly, the price is slightly above the EPS line. But in the long term, it can definitely make up for a lot. What's going on with Comcast Corporation? The stock is currently at a historically low valuation of the price to earnings ratio of around 8. This has never happened before, except in 2022. Now, many telecom companies are not doing really well. Comcast, of course, cable provider. But what's going on here? It seems that the stock is strongly undervalued. The EPS growth estimates from analysts are an EPS growth of around an average of 6%. The normal multiple has been a bit higher over time, but recently, over the past 5 years, only 12.x. We see that the current price to earnings ratio is relatively low. And if we have it on the screen, And indeed, there is profit growth expected for the coming years. Then Comcast could achieve a return of over 20% on average, and that is definitely significantly more attractive than the S&P 500. Comcast has a competitive advantage, but a downside is unfortunately good, so you don't really feel that too strongly. So the valuation seems cheap in the short term, but the luck ratio is 1.7. That's not good, especially not compared to the sector median. The price to cash flow ratio is indeed low. In the meantime, you can receive dividends just by simply waiting, about 3%, but be careful, the debts are quite high. Total debt is, of course, very high, and that's a big risk for this company. So make sure to thoroughly investigate what the debts are and whether they are mainly long-term debts and if the cash flow is sufficient. Speaking of that cash flow, they are quite profitable. The profit margin has even risen to 13%, significantly higher than the sector median. Mutual equity seems positive at the moment, and they are also generating a lot of operational cash flow. So this company has, as you can see, poor momentum, but profitability is strong. And if they just keep investing profitably, that could lead to growth. Still, the growth outlook doesn't look promising, super interesting. And the EPS growth for the coming years is projected at about 5% per year. But here, there's always reverse thinking or thinking outside the box. The expectations are low, the price is cheap. It's relatively easy for management to exceed expectations. And if that's the case, then Comcast could rise very sharply. But whether that will happen, I wonder. Wex Ranker gives a hold rating for the very short term of quarterly results. Their price target for the next 6 to 12 months is 38, slightly above the current price. We see the same thing here. The stock price is significantly below the EPS line, but it might take a long time before Comcast realizes its potential, and maybe never. The company Seagate Technology with the ticker S2X has good potential for both the short and long term. The company makes storage media, primarily hard drives, but also, for example, cloud solutions. And now the stock seems historically a bit undervalued after a significant drop. And if we look at the historical valuation in relation to regarding the upcoming EPS developments, analysts' expectations are quite high, with a growth forecast of 28% for 2026 and another 13% in 2027. Here we see a potential high return of 60% on average per year. But of course, we're not going to do the usual, maintain a multiple of 28. Let's be much more cautious. And let's hold on to, for example, 14. What is in line with price to earnings is equal to 15. In that regard, compared to the current price to earnings is, in combination with profit growth, a return of about 23% per year is still possible. On average, this will undoubtedly have its ups and downs. And Seagate Technology isn't necessarily a great company, but it also seems to be looking good statistically based on factor analysis. It gets a buy signal, especially regarding the combination of reasonably acceptable valuation with a price quite to earnings ratio, hunting treasure at 16. Certainly that's lower than the sector average and also lower than the S&P 500. And look, the loss ratio is even set at 0.26 in this data model. That would indicate a very undervalued situation, but I don't believe this. Too much of it. Always be careful and holding on to your assumptions. The price to cash flow is okay. They pay out some dividends. The potential risk here is that the debt of 5.5 billion is relatively high compared to the EBITDA. A little more than 3 times the EBITDA. You actually want that ratio to be below 3, or even actually well below that. They have enough cash in the short term, so solvency is okay. Revenue growth seems to be reasonably okay for next year, but it's mainly about the EBITDA growth for next year, which is estimated to be so high, and we see the EPS growth of even 50% for the next 3 to 5 years. Well, here the question is always why. In these alternative models, we also see different figures. So here you need to do some fundamental analysis as an investor. The company has a competitive advantage, but I don't know the company well enough, so I can't give you any more meaningful insights. For that, you really need to do your own research. Let's take a look at some numbers. In terms of profitability, it looks good. That leverage free cash flow margin is a bit on the low side. That's negative. But other things are positive, like the return on total capital. The cash flow, that has actually been much higher over the past 5 years, as you can see. But now it's starting to climb back up towards a significant drop. Look at the short term. Zexchengen indicates a hold rating, and the price target is a plus 7% return for the next 6 to 12 months. Well, as a stock investor, you don't really wake up to that. Preferably much more It could be that in the future, if these EPS expectations are met, and the EPS is earnings per share, and that's really what it's all about. But definitely also look at the development of free cash flow. That's actually even more important for the long term. Then it could, so the return could be quite attractive. At the company Allstate Corporation, there have been some interesting fundamental developments from management that could significantly boost profits, pushing up. And recently, the company has also been in the news due to a number of disasters, a major disaster too. And the company is financially affected as a result. And as a result, the profit expectations in the short term will be less favorable. It's a shame compared to, let's say, 3 months ago, when it looked much better. And that's the world of investing. Some things can change, especially in this case with Allstate Corporation. What an insurance company is. Yes, external influences can definitely have an effect, but for the long term, it still seems like an interesting stock. The current price to earnings ratio is around 10, not super high. And we see that the EPS earnings expectation for this year has been adjusted downwards by minus 3%, but then a recovery of plus 20% and plus 6%. This could lead to an average return of about 6% per year. However, the normal multiple is a price to earnings ratio of 12, which seems more reasonable to me for this type of company. And then you could achieve an average return of about 12.7%. Of course, everything is for indication and guidance. You understand how it works? Let's look at the factor analysis. For a long time, Allstate was doing very well in terms of factor analysis because it was a twang bay. But recently, it has become a hold because the EPS revision has been adjusted downwards because of this fundamental news. By the way, that's a short-term development. Pay attention. The current price to earnings ratio is then estimated to be around 10.8, with a bad ratio, very low, but let's ignore that in this case. Price to cash flow, fairly healthy. Of course, you always need to take a look at the balance sheet of this company. That's important. When it comes to good numbers, there are high expectations regarding EBITDA, growth, profit growth, and therefore also EPS growth. This number does seem very extreme, high. So in this case, I won't pay too much attention to this. When you see these kinds of extreme numbers in data models, and this cautious assumption seems realistic to me, Allstate will still not be my number one investment. I'm not going to invest in it myself either. Investing, but it could be that the company performs well in the coming years because of these fundamental developments. The current profit margin seems a bit on the low side, certainly compared to the sector median. But you also see that compared to the 5-year average, it is starting to increase. So the tenant is up, and that's an important trend. Research, that's why I'm looking at this company on a fundamental level. The short-term rating gives it a hold rating, and the price target is only $200. Within the low price, there is no price return. The price buzz is also somewhat around the EPS in the short term, so the coming 6 to 12 months, and then we also expect growth again. For the long term, it's a different story. Long-term trends, of course, because of the business model. But in the short term, there could be setbacks, as you can see. And finally, we have the company Eleven's Health, also known by the name WellPoint with the ticker ELV. Now it seems that after a recent drop of about 30%, it might be undervalued in the longer term. But yes, you do need to have a longer term horizon and therefore more patience than a goldfish. But if that's the case, maybe it offers a chance for a more nice because returns. Note, always do your research on the companies before you start investing. Also management that knows how it works. The current price to earnings ratio has dropped significantly after the decline, making it seem likely that there are returns to be gained. False. The EPS estimates from analysts are shown below, and on average, let's say about 10% for the next 3 years. If this is true, the normal multiple is around 15, sometimes 13. So let's take it a bit lower and use a multiple of 13. Because the stock has dropped so much, it's now back on the radar. Upside potential, maybe around 15% on average per year. In the analysis, it currently gets a hold. For some reason, we see that the valuation grade is a B, while the stock seems to be cheap. For example, with a price earnings of 12.6 for next year, and the PEG ratio of 137, but still it gets a poor score, probably because the PEG ratio is at 8.4. Now, I use multiple screeners, and you often see this kind of, yes. Let's assume it's a mistake in the algorithm, and you should never rely 100% on algorithms, but screeners are definitely useful. especially factor analysis. Seeking alpha, where I have a lot of faith, but you should never take it for granted blindly, of course. Sometimes even a strong sell can be a rating. It's actually a strong buy based on long-term investing because it is simply fundamentally undervalued. So that means the price is below the intrinsic value for the long term. Watch out for this company. That joy, of course, and that cash position. Examine the balance sheet. You also understand what kind of company this is. There are always risks involved, and that's why you also see such a short-term price drop. Yes, it can happen. Good. It doesn't really look very promising regarding these estimates. Here, we see the EPS estimates from analysts, and that seems to me to be an acceptable average of about 10%. Profitability is not superior, although the return on equity over the last 5 years has been quite good at 16%. Not extremely good, but not bad. And that net margin has actually been quite low for a while. Big companies too, so I don't expect too much from it. On the mother term, Zexkin gives it a hold rating. We indicate that the value is an A, but that the growth is poor. Well, we see that we've just established. We also indicate that the momentum is poor. That is, of course, also due to that recent price drop of 30%. This won't be the best company that I can recommend. But here we're talking about 5 interesting stocks that might be undervalued, established companies, established earning models that brings an advantage. Maybe you see more potential in this story. Zexmac indicates that their price target for the coming months is slightly higher than the current price. So not really remarkable. Higher. And it's interesting to perhaps look even more at that. Due to that recent price drop, the stock price is back around the EPS line. Of course, you'd prefer it to be even lower. That's what we've also learned from Peter Lynch and other investors, of course. But with good stocks, it's always about that. You just want a solid valuation with profit growth. Profit growth is often more attractive than revenue growth. But yeah, sometimes you want something different. So that was it. Possibly interesting. Of the 5 mentioned stocks, I think the Expedia Group is the most interesting. And maybe Cast will come back for the long term if they can regain positive momentum. But it will probably disappoint. And I would personally go for Expedia Group. Just to clarify, disclaimer, I have no position in any of these stocks. The only one I have that is somewhat similar is a competitor of Expedia Group, namely Booking Holdings. But recently I also sold a part of my Booking Holdings due to the valuation. And maybe if these stocks drop further, I can buy them back. And I prefer Booking Holdings and over Expedia Group, but that's a personal choice. Thank you for watching. Let me know which stocks you find interesting. Maybe I'll include them in the next analyses. And I would say until next time.